In this video, I'll be talking about step acquisitions, which are covered in FASB Codification 805.10.25.10, and in that specific paragraph it says, in a business combination achieved in stages, the acquirer shall remeasure its previously held equity interest in the acquiree at its acquisition date fair value and recognize the resulting gain or loss, if any, in earnings. And so from this sentence we can see that under step acquisitions, we'll need to revalue the initial investment up to fair value, and we'll also need to recognize a gain or loss. For my current event, I found an article talking about IBM acquiring Ustream in 2016. Ustream is a video conferencing service that IBM acquired for approximately $130 million, and IBM also acquired several other similar companies around the same time, and the article stated that this was to try to counteract the revenue declines that IBM has been having. And so that is a current event related to my topic. So now we can go over a problem related to step acquisitions. I pulled this problem from one of the videos on the Farhat Accounting Lectures channel on YouTube, and this problem uses the cost method, and we're given all of this information about the companies. We're told about the subsidiaries' equity accounts, the payments made by the parent company for the subsidiary stock, and we're also told that we can assume that the difference between implied and book values relates to goodwill, and the subsidiary doesn't distribute any dividends. I've already gone ahead and calculated the dollars paid per share for the first and second stock purchases, and we'll use these numbers later in the problem. So moving down to step 1, we want to calculate the implied value of the subsidiary company when control is achieved. So we need to take the payment made by P for 75% interest, and we also need the percent acquired for that payment, and if we take the payment divided by the percent acquired, that'll give us the implied value of the subsidiary, and if we multiply that by the total ownership interest that we have, it will give us the parent share of the total implied value of the subsidiary. Then moving down to step 2, we want to put together a computation and allocation of difference schedule. So first we need to calculate the value implied by the purchase price, but we already calculated that, so we can just drop that in. And then we'll need to subtract out the book value of equity acquired. So we need to take $120,000 for retained earnings plus $100,000 for common stock, and the difference between those is the difference between implied and book value, which is $30,000. And then we were told that all of the difference relates to goodwill, and so we can allocate all of it to goodwill here, and then the balance will be 0. And then we want to allocate these total values between the parent share and the non-controlling share. And so to do that, we just need to multiply the total value by 90% for the parent's share. And then since it's the same formula for all of these cells, we can just copy the formula down. And if we don't want to change the formatting that we've already set up, we can right click and drag down and then select fill without formatting, and that way our formatting won't be changed when we copy the formula down. And we can do the same thing for the non-controlling share, but multiplying by 10%. And again, we can copy the formula down without changing formatting by right clicking, dragging down, and then selecting fill without formatting. And so then we have our schedule all put together, and we can move to step 3, where we'll need to revalue the original 15% investment to fair value. So first we need the initial purchase price, which was given as $24,000, and we also need the change in retained earnings of a subsidiary since acquisition, and we need 15% of that, since that was the initial investment percent. And so the change in retained earnings was $120,000 minus $40,000, and 15% of that is $12,000. And from those two numbers, we can add them up to get the implied carrying value of the initial investment. And then we want to calculate the revaluation gain, and so we need to take the implied value of our original 15% investment, which will be the number of shares we purchased at that point times the dollars paid per share when we achieved a controlling interest. So it'll be $1,500 multiplied by $25 per share. And then we need the implied carrying value of the initial shares, which we just calculated at $36,000. And the difference between those two numbers gives you your revaluation gain of $1,500. And then to see what we do with that revaluation gain, we can look over at the parent company journal entries. And so I've already entered the first two parent company entries that were made for this step acquisition, but then the third entry they make will need to be this revaluation gain. So they're bringing their investment up by $1,500 and crediting a gain on revaluation. And so then we can move to step 4, which is the work paper entries. The first entry we need to make is to establish reciprocity. And for that, we've already calculated the number for this. It's just this 15% change in retained earnings. And then the second entry we need to make is to eliminate the investment account and establish the non-controlling interest account. And so first we need to debit common stock, which is $100,000, and debit the beginning retained earnings of the subsidiary. And since we're in 2012 making these work paper entries, it's $120,000. And then we've already calculated the difference between implied and book value, and so we can pull that number from over here. And investment in subsidiary company, we need to credit that for $225,000. And non-controlling interest in equity, we've already calculated over here, so that's $25,000. And then our last work paper entry that we need to make is to allocate the difference between implied and book value. And so since we were told that all of the difference between implied and book value relates to goodwill, we can debit goodwill for $30,000 and credit the difference account for $30,000.